Hello there. Can someone tell me if you can hear me?
Yes, sir. Yes, sir.
Yeah.
We can hear you now.
So do I take it that all this time you were not able to hear me?
Yeah.
Okay. Can you see the presentation?
Yes, sir. We can see.
You can see the presentation?
Yes, yes.
Okay. So let me just go back again. I was just saying that we have something called macroeconomic concepts, like, we have to segregate between micro and macroeconomics. Okay. Microeconomics deals with, companies, individuals, uh, on a smaller scale, hence the word micro there. Okay. But what we are talking about in this particular session is on macroeconomics, where we're looking at world economy or the Indian economy and the performance of the economy in general, where the government has a major say, yeah, in the particular, uh, uh, in managing the macroeconomy. And when we're doing that, there are measurement tools, like we have economic indicators, and these economic indicators, we will look at some of them as we go ahead. And just an economic indicator on its own doesn't make sense. We should be able to compare it. We compare it with a similar indicator of a probability of the previous quarter, previous year, or we can compare indicators from one country to another country to see where you stand and what corrective actions can be taken. So managing, looking and studying the economic indicators is a continuous job. Okay, just continuously we have to do that. The other thing is we are looking at growth, recession, inflation, interest rates. This is what macroeconomics is all about. And hence here we'll go into this in depth in the slides as we go ahead. So here, let me go to the next slide. So what's the role of the government here when it comes to macroeconomics? We're looking at controlling inflation. And here, this is where I was in a few minutes ago. And I was basically saying that you must have seen last week the inflation figures have come. The government has successfully brought down inflation slightly. However, it has its own impact on employment and growth and things like that. So all those connections between inflation and other aspects we'll be looking at shortly. The other role of a government is to basically to promote employment. Okay, so um, and then stimulate growth. So when they're doing playing around with inflation or trying to reduce inflation, they're doing something with the interest rates and so on. It has a major impact on many things. So other thing is the aim. What the government tries to do is tries to stimulate the growth in an economy, because if you have growth, then automatically you have inflation, you have employment, and of course, there's other major role of maintaining price stability. And again, that is related to inflation again. Now, all enforced via stated policy. So one of the most important things that the government does is that it creates policy. They create macroeconomic policies to attain their objectives of creating employment, reducing inflation, stimulating growth, maintaining price stability. And this is all done through policy. So let's look at some of the policies, right? So government has various tools to control the economy. So via stated policies. So they have monetary policies and fiscal policies and so on. And sometimes they have a mix of both. So we will look at these in first of all, what exactly is a monetary policy? Monetary policies are policies which are controlled via the central bank. Yeah, in our case, in India, it is through the RBI. So RBI is our central bank, and the, the, the policy generally helps through the bank to control money supply and interest rates. Aim is to control inflation and promote growth. So, for instance, if you control money supply, yeah, uh, it has an impact. Yeah, it has an impact on growth. So, if you are going to push money into the economy, for example, recently you must have seen that the government is starting lots of projects, right? So many projects have come into play. The government is funding projects. In fact, yesterday's news, I think they said that they talked about new projects in West Bengal, and they're talking about some funding of projects in Bihar and so on. So what that really does is that when that money is planned for various projects, they're really pumping money into the economy, right? So that is the so be and or if they want to control money supply, they have other tools to reduce or pull out the money from the economy. So we'll look at that again as we go ahead. But just remember one thing: monetary policy is implemented generally by the central bank, and they do have many tools with them, I'm talking about the central bank, to control money supply. And they take the decision regarding the interest rates, whether to increase the rates or reduce the rates. Generally speaking, if there's inflation, then interest rates tend to go up, because once interest rates go up, then there'll be savings rate go up, and people don't borrow more money, and hence it does have its own impact on on money supply in the economy. So the monetary policy generally aim is to control inflation and promote growth. Then you have something called a fiscal policy. This is the government that does it. You can see it's from they play around with taxation and government spending. So this is the way the fiscal policies come into play. And generally, if you're looking at the budget is a very good place from where you come to know what is happening to the taxation. Basically, this is again, they're trying to limit or increase money flow into the economy. And what we see in India is basically we see a mix of both. So we have a quite a bit of monetary policy activity taking place via the Reserve Bank, and we also have lots of fiscal policy, which is being implemented via, and you come to know about it in the budget, and then it gets implemented at different points in time. So what we see is a mix of both. Okay, so let's see if you look at this, what this particular chart that you can see, this is showing economic cycle. Okay, so it says economic boom and recessions and recovery and so on. So government normally wants to see governments want to see a boom in the economy. The minute you have a boom, then it takes care of lots of other objectives like employment, yeah, and creating employment for the citizens of the country and so on. So booms is very important. Everyone wants to get there. Uh, every country is at a different point in time. In fact, at this juncture, most of the countries in the world are either in recession or heading towards recession. Fortunately, here in India, we are looking at expansion, and we're anticipating an economic boom. However, that particular word cycle is very important. All countries go through a phase, and it's a cyclical movement where you see countries going, booms and bust as we call it, uh, and they go through a expansion and recession. So I'll talk about recession in a few minutes so that you'll have a better understanding of that recession. uh, right now there are many countries in Europe like UK, France, Germany, uh, Australia, which they themselves have declared that they are in a recession, and America is apparently heading into a recession, but they have not stated it. Yeah. Whereas in India, we are talking about a boom, which is we are into a boom, and yet we are just at the start of it, and we'll see where we go from there. So I'll come back to this particular slide in a few minutes. But what exactly is a recession? So in a recession, there's a slowdown or contraction in financial activity. Yeah. So all these countries that I talked about just now, like Germany, Great Britain, France, Australia, they are already showing signs of a recession, or rather, they have declared that they're in a recession where there's a slowdown of the economy, there's contraction in financial activity, and with the result, what is happening is there are lots of people are in unemployment, a lot of people are, in a state where they're probably losing their jobs and so on. And there's a slowdown in the entire economy. So that when you're talking about recession, we're talking about slowdown in the entire economy. For at this juncture, we are not in a recession. So what is a signal for a recession? Generally, we can see the third point there says GDP. But there's only one of them. Okay, so GDP is your gross domestic product, and when you look at the gross domestic product, you normally see that the GDP rate, the GDP is going down. Yeah, so that is a sign that we are going into recession. So gross domestic total, what exactly is gross domestic product? Is the total value of goods and services. Now, if you don't have people in employment, so there are a lot of people not working, there are not enough goods being produced, and hence the measure is calculating a lower gross domestic product. And if you are comparing, like I said earlier in one of the earlier slides, when you see that in the two consecutive quarters, there's a decline in gross domestic product, right? Then we say that we are in a recession. So the general norm is that if you have 2 quarters of a declining GDP, yeah, then you can state that you are in a recession. Okay. Uh, so what the government does is it wants to make sure that it doesn't come into this particular situation. The minute it sees a decline in GDP, then it has to pull up its socks and do something that in the second quarter it does not continue. There's not a continuous fall in the GDP, so they have to take some fresh measures to ensure that you don't get into a recession. Getting into a recession uh, is it is not a nice thing, because coming out of a recession can be a very painful thing for any country. So countries try and avoid recessions, because, like, again, I'll repeat again, it's basically you're slowing down. There's a slowdown of financial activity, slowdown on economic activity, and it is if it continues from quarter to quarter, we say that we are in a recession. So if I go to the next slide now, uh, just a moment, give me a minute. Okay. So this one is just an interesting one. I'm trying to make sure that we have a mix of some, not just all everything to read, but something to look and enjoy. Because I know you all had a hard day at work in the morning today, and you've been working, and you've probably come home, or you're on in office. I'm not sure. Some of you might be there, but this particular slide is talking about interest rate and growth. Okay, so if you look at the red line there, yeah, the red line indicates interest rates. Okay, and the green line is talking about the growth. So what this is basically saying is that if you reduce interest rates, okay, it eventually leads to growth. Okay, that is what it is saying. But the minute interest rates go down, it creates different kinds of problems. When interest rates go down, they create an inflationary tendency. So it is a balancing act. So you might think that reducing interest rates is a smart thing and is a right good thing. Yes, it is, because it stimulates growth. However, the balancing part is that the minute interest rates start going down, then they have its own impact. It impacts inflation. Okay, and inflation is not a good thing. Okay, so generally speaking, there is a connect between interest rate and growth, and hence the government through macro.
Sir, again, you're on mute.
Sir, you are not audible.
I think someone is. Are you okay? Am I okay there now? Are you there? Now you can hear me.
Yes, yes, sir.
So I'm not sure. Someone is muting me. Please don't mute me. Yeah, others are listening. I think someone is muting me, because I just now unmuted myself. I just found that someone had muted me. Okay. So can you see the presentation now? Hi, can you hear me? Hello,
Yes, sir, you are audible now.
I'm audible, but can you see the presentation?
Yes, yes, we can.
You can.
Yes, sir.
Okay. So I think you can do me one favor. Whenever I change the slide, let me know that you're hearing me. Okay. So I'm changing the slide. Can you hear me now?
Yes, sir.
Yeah.
Yes, sir.
So when I explained this slide,
Yes, sir.
when I was explaining the slide, were you able to hear me, or do you want me to go over
Yes.
this again? Hello. Hello there. Maybe I should. I'm trying to. I'll probably connect through another window, so that what it probably will do is that I'll have a separate, because you don't seem to be answering me regularly. Hello there. Can you hear me now?
So you're audible.
I'm audible. Okay,
Yes, sir, you're audible.
I'm audible. Okay. So when I explain this particular chart, were you listening, or do I start again? Yeah. Hello. You want me to explain this chart, this particular slide again?
No, sir, understood.
You want me to explain this chart, this slide again?
No, sir.
You're okay with
No,
this
sir, please
slide?
continue from here only. Yes, sir.
Yeah, okay. So basically, what I was saying is that it's a balancing act for the government. Okay. So they're taking care of if they reduce interest rates like they did last time and they're planning to do so, it has a positive impact because what happens is the growth goes up, right? It's a balancing act because, okay, I've changed the slide. Can you hear me now? Yeah. Tell me that slide has changed.
Yes,
Yeah.
sir. It's changed.
It has changed. So you can see what is happening here. When interest rates come down, it has a tendency for inflation to go up. Okay. So the low interest rate, what does it do? It impacts savings rate fall. So if interest rates go,
So, which interest rates are we talking about? Sorry, you are on mute. Sir, again, someone has muted you.
hey, hey, Piyush there. Piyush, please don't mute me. Yeah. Okay. All right. Okay. Can you hear me now? You can? Can you hear me?
Yes, sir, we can hear you now.
We can hear you.
Yes,
So
yes.
what I was basically saying is that when interest rates go down, money becomes cheap, and then if you won't save money, savings rate fall, and people start spending money, and it creates inflation. However, the government does not have enough money because normally what happens is when everyone starts saving money, the government has funds on hand for projects, and if they don't have funds on hand for projects, then they will not have projects, and they will create unemployment. Okay, so that is the point of the matter here. Okay. Now you talk about financial literacy. Okay. Now you have to empower yourself in an understanding of economic information. Okay. So you must have adequate information, economic information. So you must make sure that you are using that information wherever you're working. Okay. So you have to utilize the language of finance to confidently communicate. So wherever you're working, you make sure that you're able to use the information that, uh, regarding all the policy changes that are taking place, that you read in the newspaper, that you read or you hear on television news. You should be able to communicate confidently with your peers, and you should see what impact it's going to have on the company that you're working for. Okay, you should understand and effectively use published economic information. You should have knowledge of various principles which will help in decision making, and you have to able predict future direction of the economy. Now, here, what basically when I talk about financial literacy, what I mean here is that you should be, after all, you're doing an MBA, you should have enough information on hand to converse with your colleagues, with your bosses, as to what is happening in the economy, why it is happening, and what the macroeconomic changes that are taking place, how they would be impacting the business that you are in. So, whichever company you're working for, you should be in a position to guide. Not you're not guiding. You should at least be able to converse. You should be able to let your peers know that you know what is happening around you. Okay. Now look at this. This is about economic growth. Okay. This is a very interesting piece of information. Can you see the slides? Can someone tell me that you have seen the slides? These charts. Are you able to see them?
Yes, sir.
Yeah. So
Yes,
if you look
sir.
at the
Yes,
one
sir.
on the left, yeah, if on the left what you're seeing, this is from RBI, is basically saying it says where we are, right? I can, if you can see the arrow that I'm my on of my mouse, you can see that we are anticipating a trajectory. Yeah. So we are talking about the India's third giant leap. Okay. So this is where we are. This is what we are anticipating that's going to happen from now on. So from 2025 onwards, this is what we're expecting. Now, if you look at the this particular chart on the right hand side, you'll see what is happening to Japan. Japan is in red. Now, in Japan, these guys started moving somewhere in the 80s, and they had a massive growth, and hence the kind of development Japan has seen. So, whenever we talk about developed countries, we always talk about Japan. And by the way, the place where they are right now, where they find themselves, that happened somewhere in the 80s, right? In the early 80s, they took some right decisions, and which with the result, they are where they are right now. The second one is may not be in the same league as Japan or in US or maybe Germany. They are not in the same league, but they too were almost a developing country like India until the early 90s, and see where they are now. Yeah. Whenever you have time, just do a Google on South Korea and you will get an idea of what the kind of lifestyle they have. They were very, very rich, right, lifestyle. Look at the green one. The green one is China. You can see it's going really flat until 2000. So somewhere in the late 90s, they started moving very, very rapidly thanks to the kind of uh, investments which were made by investments which were made by US into their economy, and they, you can see the trajectory that they had. Now, all this is mainly, it's all spillover of macroeconomic decisions which have helped their manufacturing. Now, we in India, we are going to, we already started seeing this, and hence you must be reading in the press about the big change that is happening. In fact, in my one of my earlier, I think the two or three slides earlier, I mentioned to you that we are not in a recession, and in fact we are in a very, very a good place. We are almost at the start of a boom, and we hope that we will be somewhere there, our performance will be equal to that, or something of that nature in the coming days, right? So economic growth is very important, and hence the management of the macroeconomics through either a physical policy or a macroeconomic policy or a mix of both is very, very critical for growth, because one of the things it does is it takes care of unemployment, makes sure the standard of living improves, and savings start going up. Now, here we are talking about asset classes. Okay, in this particular chart, I've got asset classes. Now, these are the asset classes. We've got capital markets, debt market, currency market, commodity market, money market, insurance market. Now, all these markets, okay, they are they tell you where the economy is heading, right? So we look at the capital markets, look at the Sensex, where it was say 5 years ago, where it is today, where we are anticipating it to go. We look at the debt market, we look at the interest rates, where they were, where they are now. But debt markets are much more difficult to manage and to take care of, because what normally happens with the debt market is that the underlying for a debt market is interest rates, and interest rates are impacted by what is happening to interest rates in other countries. And anything that is happening in other country regarding interest rates, we in India respond to it in a majorly way, and hence that also has an impact. Even though we, when I say we, I mean the government is playing around with the interest rates because it wants to help our economy. They want to reduce interest rates so that people will borrow money and invest in the economy by maybe starting new companies and so on, and maybe more startups and things like that. But there is a limit as to how much they can do, because interest rates get impacted by what is happening in other major economies, especially in America, the American economy. So these asset classes, we look at the currency market here. One of the challenges is to see where the exchange rate is, and we are looking at, generally the world looks at the dollar rupee exchange rate. I mean, I'm talking from Indian point of view. The world looks at the dollar vis-a-vis their own currency. So Japan looks at dollar and yen, or the euro. Europeans look at the dollar euro. The British look at the dollar British pound, and hence we in India will look at what is happening to the rupee vis-a-vis the dollar. And we can look at what we have been seeing in the last couple of years. The rupee has been appreciating, okay, meaning that we pay more rupees to buy every dollar. Okay, now that is a sign that our economy is not doing as well, or perhaps the dollar is doing far more, is doing better than our currency. But the minute like, if you go back to my slide, the first slide on on recession. If America gets into a recession, what will probably happen is that dollar will weaken and the rupee will strengthen. So the rupee, which is perhaps 87, 88, yeah, to a rupees to a dollar, when you talk about a strengthening of the rupee, you'll end up paying 85, 84, 83, 84. We move that direction when the rupee starts strengthening. In other words, we pay less rupees to buy every dollar. Okay, so that is strengthening of rupee. So when all the macroeconomic policies, once they get impacted, we look at the Sensex or the Nifty to see whether the macroeconomic policies are working. We look at the direction of the interest rates. We look at the exchange rates, where they're moving, which direction they're moving. We look at the commodity prices. We look at commodity prices to see whether commodity prices are weakening or they're strengthening. So we look at gold majorly. We look at the bullion segment. Uh, that's a very good indicator. And when you look at the oil, now crude oil, yeah. But the point problem here in markets is that it is getting impacted by various other factors, and hence within the asset class, commodity markets is becomes very difficult to use those prices to assess whether a macroeconomic policy is working or not. However, if you are in this particular market, you will follow the price movements that are taking place, and you will uh, you you will have to have a very good grip on the commodities to see what changes are happening and in the world economy pertaining to uh, to commodities, right? And so it becomes a little more difficult. However, debt and currency markets are a very fair indicator of whether
उनका लॉग आउट हो गया है क्या?